Hey everyone, Michael here from Adventurous Real Estate Investors. Today, I'm coming to you from the Prague Castle. It's behind me here, starting to light up a little bit here. Well, actually that's the cathedral here. And this whole area here is the actual castle. Dates back to 9th century. So actually dates back to 889. The cathedral behind me here dates back to the 14th century, which is pretty cool. It took 600 years to complete it. In this video, I'm going to talk to you about our investment thesis and how it has changed based on the current economic situation. If you want to go back and look at our investment thesis that I put out a video back in 2021, you can go and check that out. There's a link below in the description of the video. Go and check that out because you'll notice in there that I go over three main core tenets of our investment thesis. And the first one is returns. The second one is the markets. And the third one is the property classes. So I'm going to briefly go over what things have changed and what things have stayed the same in our investment thesis. So you can kind of understand where we're going and what we're looking for given the current economic situation. So the first one is returns. Obviously, we're still looking for cash flowing properties from day one. That hasn't changed because we don't like to take on that amount of risk when a property is not cash flowing, or we have to get it to a position where it starts cash flowing. So we're always looking for cash flowing properties from day one. They have to be stabilized, meaning that they're 90% occupied for at least 90 days. And that's another thing that we look for. But as far as returns go, the lending environment right now has changed where interest rates have gone up significantly, which has obviously driven down cash flow. When interest rates go up, it obviously eats away at cash flow. Therefore, you might see, well, the returns that we're looking at right now are a little bit lower than they were when we had a very, very extreme low interest rate environment over the past year. We're still looking to give preferred returns. However, those preferred returns might not be the specific 8% that we have been given in the past as well. So we're looking at 6 or 7% preferred returns. We're still looking to achieve an 80% or greater total return on the investment. So if you invest $100,000, you'd get back at the end of the investment $180,000 or more. So $80,000 back on a $100,000 investment. We're still looking to achieve those returns over a 4 to 7 year period. So that's kind of how the returns have changed just slightly given the current economic situation based on the higher interest rates. The second one is markets. Nothing has changed there. We are still very, very bullish on the markets we invest in, specifically Tulsa and Oklahoma City. If you want to learn more about why we love Tulsa, again, in the description below, you can find a link to a video that explains exactly, I think it's 5 reasons why we love Tulsa specifically. And the third one is property classes. So previously we were going after, C class, but also B class properties. And we've kind of shifted that interest more towards B class. The reason why is because labor and cost of rehabs and CapEx projects, things like that have gone up quite a bit. And so we're looking for properties, B class properties specifically, that have a light value add component, so it doesn't require a lot of CapEx expenditures, but these properties may have more of an operational inefficiency. So Suzy and I can leverage our relationships with our property management company, with local vendors and things like that, in order to decrease expenses while also increasing the NOI when we do that, thereby increasing the value of the property and increasing the returns to our investors through that specific scenario there. So again, we're looking more in the B class range now. Of course, we still really enjoy doing the C class properties. We really enjoy those value add strategies. However, we have to make sure that we have the proper CapEx contingency in each of those budgets. So typically we would have 10% contingency in our budget, and now say $500,000 in CapEx. Now we typically had $50,000, so 10% in a contingency budget. Now we're increasing that on our last property, for example, increase that up to 30%. So we have $150,000 in contingency. So those opportunities we are still looking at. However, we have to make sure that the contingency that we have in the underwriting and specifically in our CapEx budget is increased enough in order for that opportunity to make sense for us to pursue. So again, the 3 basic core tenets of our investment thesis is the returns, which I discussed, have changed slightly because of the higher interest rates. The markets, they haven't changed. We're still very bullish on Tulsa, as I mentioned. And the third one is property class. We have shifted slightly out of C class, now moving into B class, which gives us a lower risk profile, giving the lower interest rates and the increase in labor costs. If you like this video, please subscribe to our channel and ring that bell so you'll be notified of any future videos that we release. Until next time, explore more adventure ways.